Well, welcome back, everyone, for another amazing episode of the Never Broke Nation podcast, where we help you make, save, and grow your money.
Yes.
So I'm excited to be one of your hosts today, Janai Thornton, here with Miss Chris Hollis. Yeah. And so, Chris, we got another great one today.
Yes, we do.
Another great one. Another great topic today. So excited to have Miss Micole Sudduth with us today. Mortgage banker, Bank South, forever and ever and ever. I'm like, I can't believe you've been in the business for 18 years.
Yes, ma'am.
Yeah. I don't know how long I've known you now. It's been a minute, though.
It has.
Yeah.
It's been a while.
I've actually done a refinance with Micole before.
Yes.
So, yeah, I have some real personal experience with her.
Yes.
But I'm really excited about this topic because this is an area where I see a lot of fear still with people.
Yeah.
I see people who too afraid to buy.
Yes.
Don't think that they qualify. And just people who really just don't know what to do.
Right.
So we have a lot to get people ready to buy. Our first time folks.
Yes.
People who are ready to kind of step up, do something new. Maybe we have some investors out here. So no matter who you are and the spectrum of real estate, we're here. So before we kind of get into it, I want to make sure people know where to find you. So where are you out there on the web or social media?
Social media.
Yeah, where people want to get in contact with you for business.
For business purposes.
Yeah,
only.
yes.
I am on Facebook at the Sudduth team. Facebook. I am at MS Sudduth on Instagram and Micole Sudduth on LinkedIn. I'm horrible with social media, you guys. So I guess I did that correctly.
Okay.
So reach out to her, and can you only do mortgages in Georgia?
No, the southeastern.
Oh,
state.
the whole Southeast.
Yes.
Nice. Nice to know that.
Get with her, guys.
Come on now.
Yes, ma'am.
And so we're going to kind of start at the beginning of the spectrum or the process.
Yes, like as being a newbie, someone who is about to purchase a home for the first time, or they want to.
Right.
What should be the first thing they should do?
Well, the first step would be to contact a loan officer like myself, because your financing, of course, is the foundation for you to find a home. So you need to know where you are credit-wise, and we'll get into other things, debt to income, things of that nature. So the first step would be to contact me, and then you just do a standard loan application,
Got it.
which is name, date of birth, 2 years employment, a little bit about your assets, things of that nature. And then that will allow me permission to pull your credit. Once I pull your credit and it meets the minimum standards, which we can get into that later as well, then I will get minimum documentation from you, such as your pay stubs, your W-2s, your tax returns. And then once I analyze that, you and I will have a more in-depth discussion about what amount you qualify for.
Gotcha.
So those are just the initial steps
Gotcha.
for getting started.
That's funny you said it, because automatically whenever I hear people talk about they want to buy a house, the first thing they start to do is to try to fix their own credit. They want to
Yes.
try to start doing things themselves, but you recommended that they should just come to you first.
I do, because there are some things that you think you may need to do for the mortgage process that aren't necessary. A lot of times people want to focus on older debts, older collections, and they also automatically assume that those are the things, if they don't have a strong credit score, that are pulling those scores down, when in actuality it's not. Your old credit has already done whatever damage it's going to do. That's that. Most people stay away from credit, which keeps their scores stagnant or low. That's the thing I see the most.
What do you mean stay away from?
So if you've ever had a bad experience with credit, then once you get it to the point where you've paid off things, you don't want to use it anymore. So you don't have any
You're
open
scared.
revolving credit. You're just scared.
Right.
You don't have any open revolving credit. You pay cash for everything, which doing that, you won't be able to generate a credit score. The only way that creditors know how to extend credit to you is for you to show them what type of a consumer you are. And that's what the credit score is for, to let other creditors know. Remember, this is not personal. I mean, there's millions of people that are getting extended credit. So they use this formula to determine if I want to lend money to you based on the way you've repaid other people. That's what it is. So you can't run away from credit and expect to have a strong score or to be able to get financing for a home or car, things of that nature. You have to be able to use it. Just use it responsibly, and then be able to generate a good credit score.
So when you say people need to come see someone like you first, is it 2 years before, 6 months before? Like how? Like what's the time frame?
Well, that can vary. I mean, I would say as soon as you figure out that you're ready to purchase, you would need to come see me. There are some situations where people are automatically ready, and then there are some where you think you're ready, but there's some things we have to look at on this side that you may not know that you need time to prepare for.
Right.
So as soon as you know that you're in the market to purchase a home, I would suggest you talk to a loan officer. When we pull a credit report, it's good for 4 months. So, I mean, of course, if it takes you longer than 4 months, we'll have to redo that. But at the minimum, that at least gives you some time before you have to actually go out and find the home. But at least you know where you are in the process. So.
And then if I come to see you, maybe I know I'm going to need maybe about 18 months to kind of get myself together. Do you have to pull my credit? You know, if I'm concerned about my score going down, do you have to? Can I bring you something like my Credit Karma report?
No.
Or no?
So Credit Karma is
a fake FICO score,
basically.
Right.
Okay. It's a consumer-driven report, or consumer-driven scores, and really, guys, it's for the purpose of the people. So think about now who sends you these scores, these Credit Karma. It's your bank, your credit cards, and what do they want you to do? They want you to go and get credit. So they give you this consumer score, which is never the same as the score we get as lenders, and it is. I mean, you
fake.
can say it's fake, basically.
Right.
Because, I mean, I've seen variances from 50 to 100 points.
Really?
Yeah.
That much?
Yeah.
Wow.
So, no, I can't use your Credit Karma credit report. I would have to use a lender-generated credit report to be able to give you accurate information.
Okay.
Let's just say that. Now, I've talked to some people, and they can give me some general information on what's going on with their credit, bankruptcies, things, obvious things, and I can tell you automatically, you need this amount of time before you can do this and this amount of time. If you tell me you have absolutely no credit, I can tell you need to go ahead and start opening up some level of credit, a secured credit card or something. So if you're 18 months out, I don't have to necessarily pull your credit, but I can, if you really want to know where you are to plan, I would suggest you allow me to. An inquiry, to address that.
Right.
An inquiry is not a bad thing. It's a means to an end. You have to have someone pull your credit in order to be able to be extended credit.
Okay.
It's multiple inquiries. That's the issue.
Okay. But they kind of need to know that they really are going to work with you, though, instead of popping around to potentially different lenders, though.
Well, they do. The credit profile is set up. If it's the same type of credit inquiry, the bureaus don't count it as multiple.
Right, that's what I thought.
Understood.
That allows you to shop
It
around.
allows you to have the
You
right to
can
shop around.
Okay,
Right.
nice.
Yeah.
Exactly.
So you're not forced to use anyone
Exactly.
you don't want to.
So if I come to you and I have low, bad to no credit, what advice would you give me?
Depending on what's causing it. So
So I have no credit.
no credit. Easy. You have to open credit. Yeah. So most of the time, if you have no credit, then your score is low. You're going to have to start with a secured credit card. You understand?
Right.
Know what that is?
Absolutely. Right.
Yeah. Because you're not going to be able to get a traditional credit card because the score is too low to get one. So you have to start there typically. But that's just to get you started. It doesn't have to be. It shouldn't be a permanent situation.
Right. And how long would that normally take before I'm able to generate a score that would allow me to qualify?
It depends on how long you've gone without any credit. Sometimes it can take. I've had people that have some other lingering types of credit that the bureaus kind of recognize as credit, even though it's not.
Right.
And they can open up a score and it can jump up immediately.
Right.
I mean, open up a card and it can jump up immediately. If you haven't had any in a while, it can take you 6 to 12 months before you see a score. If you never had any, it's a minimum of 6 months.
Right. That makes sense.
And so for our viewers and listeners who aren't sure what a secure credit card is, that essentially means you're going to get a card. You're going to have to give the bank or the lender, if you have a $500 spending limit, you're going to have to give them $500.
Right.
So this is their way of giving you some practice,
Right.
Without allowing you to really mess up. Because if you can't pay the bill, obviously they can just take it from the money
Right,
that you've given them.
exactly.
So now what about all these folks out here who know they have bad credit. They're under the 600 range, but you know, they want to buy. What do you typically tell them?
Well, I mean, anybody can improve their credit. It's just a matter of how long it takes you. So if you're in that situation where you have a lower credit score, it's just about being realistic with the time frames to get you to a score for you to be able to qualify. So once again, depending on the situation, I'm going to tell you what you need to do to get there. If you have tons of old derogatory credit that need to be addressed, then you have to address it. You know, settling. Start with the smallest to the largest, whatever it takes to get that, you know, within line. And then, but it's always going to be about maintaining your current credit as well.
Okay.
While you're working on any older things that could possibly be pulling it down. Like I said initially, most of the times that doesn't have anything to do with the score. But there are limits on things we would allow you to keep open as far as derogatory collections. There are limits on that amount. So that's when I say you may have to pay some things down to get yourself ready. But just making sure that you keep your balances. Utilization is huge. Keeping your balance.
What's that mean?
Okay.
Right.
So utilization, it can affect your score just as much as you not paying your credit. So utilization means the amount of credit that has been extended to you. So your limit versus what your balance is. You really want to keep it in that 20 to 30% threshold.
Max, right?
Max.
Okay.
That's how you keep your score at the optimal range.
Now, if I have bad credit, but I want to bring in a cosigner, how would that impact
A cosigner
things?
does not negate credit. It only adds income. So, yeah.
Sorry. Yeah.
But that's a very common.
That's a common
Because people
thing.
are looking for strategy, though.
They are looking for
Yeah.
strategies, yeah. Cosigners, we pull those in when your debt to income ratios are too high and you can't qualify for a level of a home that you want to or you feel you can afford.
So let me make sure I understand. So cosigners are just there to increase your income.
Right.
But you still have to get your credit.
Yes, both buyers on the mortgage have to have the minimum credit score requirement, whatever it is for the program you're looking
Wow.
at. Yeah. We use the lowest FICO is the determining credit score. So you can have an 800,
Right.
and if she has a 600,
Right.
the 600 is what we're using
Gonna go
for
by.
financing.
That makes
Yeah.
sense. That makes sense.
And so give people an idea of what that score needs to be. So based on different loan programs, that's a range of what to what?
So we can finance actually as low as a 580 now.
Get out. I thought it was a 640.
Well, I mean, the higher the score, the better.
What?
I mean, a 580 is going to afford you. You can do an FHA loan with a 580, but you're not going to get the same rate. And certain, I mean,
Is that what
programs,
a PMI comes into?
right? So FHA MI is there for the life of the loan, unless you put down more money, and that may be a little bit too much complicated for this particular segment.
right,
But anyway, you can go as low as 580 now. Right.
Wow.
There are some people who may even tell you lower than that. But that's FHA. Now, if you're going to do a conventional loan, which is another type of financing, another type of program, then the score needs to be a little bit higher. You need to be at least a 620.
Okay. And so just because you've mentioned it, can you kind of just briefly explain the difference, this FHA conventional? What does that mean?
So FHA is a government-backed program. So it's insured by the federal government. It has more lenient credit guidelines, debt to income ratios. That's what that's the type of program you would need for a non-occupant cosigner. So the cosigner that you need to help with the additional amount you want to qualify for. Down payment, 3.5% minimum. So it is the program that is there to help with. It's not just a first-time homebuyer program. It used to be thought of as that.
Right.
You can buy it as your first or move up. But if you're in a situation where you need the more lenient guidelines, that's the program I would use for you. Conventional is our Fannie Mae, Freddie Mac, the more private mortgage-backed companies.
Okay.
Well, not private, but they're not government insured. They have a little bit more restrictive guidelines when it comes to down payment and credit score requirements and debt to income limits.
So
you can't go nearly as high on conventional loans as you can on FHA.
Okay. So you mean like more money down, higher credit score, like you're going to have to be right for the conventional. Okay.
Yeah. They do have some more conventional programs now. They've tried to streamline those a little bit more for first-time home buyers so you can have a lower down payment. But overall, the guidelines for those programs are not as lenient as FHA.
Right.
Do you lean towards one more than the other?
I look at the total profile of the buyer to determine which one will work best for them. If you are going to put a larger amount of money down and you have a higher credit score, I'm just going to lean more towards conventional financing. If I see you need to stretch your numbers to get qualified for more, I'm going to lean towards FHA. Yeah.
Makes sense.
And if you're a veteran, we're going to do VA because
Right.
those are out there too. Yeah. Definitely. 100% financing for our veterans.
Wow. So, as you've seen, I mean, I'm sure lots and lots and lots and lots of first-time home buyers.
Yes.
What are the things that you're like, please stop. Stop doing this. Y'all know y'all drive me crazy when. What are the things that you're like, come on, people.
Well,
You know, our
Tell the
cousins.
truth. Yeah, tell the truth. Come on, Micole.
well, the biggest thing is for the first timers right now is extending that. So when you're coming out of school, you're buying a nice car, you know. I mean, you're younger, you know, that's important, but it has a huge impact on what you're going to be able to purchase.
Yeah.
That's a little frustrating. Not paying your bills on time and thinking that there's not going to be a consequence, that's
Yeah.
extremely frustrating.
Yeah.
Right.
I mean, for me, that's 101.
Right.
I mean, I'm always surprised when I have to explain to someone where their score is a certain place when they didn't make their Macy's bill payment or their
Right.
I mean, just last month.
Right.
I don't understand that. So that please stop doing that.
Right.
That's just,
Pay your bills on time.
pay your
people.
bills on time,
Right.
especially if you want to buy a home.
Right.
But I mean, what I'm seeing a lot, which is I don't have an issue with it because it's not anyone's fault, is I would really want to talk about these student loans.
Please talk about it. Come on, Micole. Bring it on in.
So they changed the guidelines for student loans 2.5 years ago. And it's taken 2.5 years for the word to get out.
Folk don't know.
They still don't know. So, you know, you're coming out of school with these large student loans. And hey, I mean, I'm all about advancing your education. But you have to understand that it is going to have an impact on what you qualify for now. Now, for FHA, no matter what, we have to count 1% of that balance. So you have $100,000 in student loans, I have to count a $1,000 payment against you, whether you're paying it or not, if you're in the situation where you have to be an FHA buyer. Mm-hmm. Conventional has changed the guidelines where if you are on an income-based payment, which 99% of people are these days, I see, then we can use whatever that income-based payment is, whether it's $0, $10, $50, whatever. So, but once again, going back to what I said about conventional financing, then you have to be in a different place with your credit score and your down payment.
Right.
Because most of the programs that we have, any of the first-time programs, they're going to be FHA. So what I would like to tell everyone, all these...
Right. Look at the camera.
Right. All of my future graduates,
Right.
if you are planning to purchase a home, make sure you save money and you make sure you work on your credit and you keep your credit score at the level that you can qualify for a home with these student loan payments, because that is a huge, huge issue. I can't tell you how many people I've had to deny because of student loans.
And I'm sure
Horrible.
Part of it is being denied, but I'm sure a lot of people in their head want to buy a house at a certain price
Of
point.
course.
And then with them student loans,
They can't.
it's not going to happen.
It's not going to happen.
So, with the different types of loans, is it better to get one from a bank or a mortgage company? Or what is the difference? Maybe I should say, what is the difference between like a broker or maybe?
There's really not much of a difference. So brokers, I guess they're still out there. I don't run into those a lot like you used to back before the housing market fell.
Mm-hmm.
Most people are a direct mortgage lender or a bank that has a mortgage, that has mortgage lending.
Got it.
So we are a bank that has mortgage lending. We were originally a direct lender, and we merged with a bank, like your Wells Fargo or your SunTrust, those are things of that nature. But you do have just mortgage companies that's all they do.
All they do.
Right.
Mm-hmm.
Which is really, to be honest with you, in this now after the housing industry, the housing market, there's really no difference.
Right. Not even with the credit union? Would that be any
The credit unions, a lot, they service a lot of their own loans. So they don't sell their mortgages off. So there are some credit unions that have niche products that they can offer that your other lenders can't, because they are going to keep the house, the mortgage in house.
Mm-hmm.
But credit unions, I say that just like I will about a Wells Fargo. They're good for checking, savings, car loans. But if you really want a mortgage that's not 20 to 30% down, 800 credit, they're not typically where people go for a mortgage.
Okay,
Yeah.
so it's for your more prepared buyer.
Understood.
What challenges have you had when you have people who have gone to look at houses first versus coming to you?
I just don't understand how you do that. How do you even know what you're supposed to do? That always,
do it all
but they do it all the time. Yeah,
They gonna pick the house, they pick the street, the subdivision.
Yes, they do.
That's one thing. No, I'm just saying that's one thing I knew not to do.
Not to do.
When they're looking, like,
No.
first know what you qualify
You
for.
gotta have your money right.
Yeah, exactly.
So I'm sure people come to you, they have looked, and then you're like, sorry.
Yes, I have. And then they're devastated.
Exactly.
Because they've fallen in love.
They've fallen in love with something they never should have been looking at in the first place.
Way out of their price
Way
range.
out of their price.
So that's really important.
That is very important to know.
You cannot be looking first.
No,
Yeah.
don't do that to
You need
yourself.
to know your range. Yeah, for sure. Now, do you give people any feedback or guidelines on, let's assume someone qualifies for a $300,000 house. Do you suggest people say, hey, based on what because you get to see all their financials,
Right.
maybe you guys should stay in the 250 range? Because I'm sure a lot of times people are going to the maximum of what they can qualify for. Tell the truth, Micole. Come on.
I don't. I used to,
Right.
but I learned my lesson with that.
Okay.
People don't want to hear that. Now,
Okay.
what I typically do when I pre-qualify all my buyers, I ask them where they want their payment. I don't even tell them, I don't ask them what sales price range they want to be in. Where do you want to keep your payment? That's the first thing I ask them. And then they tell me. And then I tell them what that means.
Okay.
And then that's how we get to that number.
Nice.
So
That's a good
yes,
way to do- okay.
yeah, and that's the right way to do it.
Yeah.
Because I have clients who, they can qualify for a $400,000 or $500,000 house on paper, but
Right.
they want the payment of a $250,000 house. So it's no need to qualify you for that if that's way outside of the realm of your budget or where you want to be.
Right.
So that's the way I do it. So
Okay.
I kind of get away from that.
I understand.
But I do have some that even if I tell them that, they still want to know their max.
Right.
And if they decide to purchase that, there's nothing I can do about it.
Right.
I try to keep my personal
Right.
feelings
out of it. Yeah.
Yeah.
I can
It's just
understand
hard
that.
to see people who are so extended. Like one life
is.
thing happens and you're like, it's a slippery slope.
It is.
Yeah.
It's a very slippery slope for me because I don't want. I can't stand that.
Right.
Financial literacy is one of my passions.
Right.
So I hate to see that, but at the same time, where I am, my position is I can't place that my personal opinion on what they should or should not do financially.
'Cause people think they're gonna do it. Like I have a friend right now who's, he just moved into a house, and I'm seriously wondering how did he get it? Because he's like already like, I'm gonna have to take out a second job just to pay my mortgage, and I'm like, you didn't know that up front?
Right.
You know
Of course he did.
Right.
He
Yeah.
knew it.
Right.
And I'm like, and did your loan people know that as well? I'm like,
Probably.
Lord, but you're right. Like you said, they get the max. So I wonder, is there a difference if someone is self-employed?
Mm-hmm.
Is the process for them different?
Yes. Well, the process is different. The documentation process is different, yes. So self-employment, if we're doing traditional, not any type of special financing, then you have to have 2 years of federal tax returns. And we are going to use the net income for qualifying. So whatever expenses you've written off of your business, whatever you decide to pay taxes on, that's what we're using to qualify. And that's another big issue with self-employed people.
Yeah, because you think, they're trying to write off everything
as much as they can.
Right.
Exactly.
Reducing tax liability is just common. I mean, people do it.
Well, let me ask you this, Micole. So for someone who's self-employed, but they're actually on payroll within their company. So I own my own company, but I'm a W-2 employee. Will you just take my W-2, or are you also you're treating me self-employed still?
I have to do both.
Mm-hmm. Okay.
So your W-2 income, I'm going to average just like I would your self-employment income. The only thing with the W-2, of course, I'm not worrying about any net.
Okay.
It's going to be whatever you paid yourself.
Okay.
And because you own the company, it's still your income, it's still your liability, or it's your profit or your loss.
Okay.
We still have to take that into consideration.
Okay. Gotcha.
And a lot of people don't know that either.
Right. Yeah. I know it's hard. I know a lot. It's kept a lot of people from buying.
Oh, God,
altogether.
yes.
Yeah.
That's probably bigger than the student loans.
Right. And do you think it's just poor record keeping? Is it, writing off too many expenses?
That's it. It's not poor record keeping. It's just a matter of, I only want to pay taxes on this.
Right.
But I want to purchase this. So.
And the government is like, how are you going to afford that?
Because this is what you said you make. You know, this is what you told us you make. So.
My last question in this whole first-time home buyers, you always hear about these first-time home buyer programs or incentives. How do people find out about those based on, what city or state or county that they live in?
Well, that's one of my niches. I primarily what I do the most of, really. So, you can go to the internet, of course, has access to anything, but I also have access to any of the programs available in Georgia for first-time home buyers.
Okay.
I'm very aware of all of them, but there's not one particular website you would think it would be where they have them all together. You have to search depending on what the geographical location of the property where you want to purchase.
Are they more county based? So for people who live outside of Georgia who are listening, is it at your county level?
Right. So we have county programs and we have a state program.
State too. Okay.
Georgia Dream has been around for years, and it's for pretty much any county in the state of Georgia.
Okay.
Then the city of Atlanta, they have a very, very strong program for first-time home buyers, but you have to purchase within the city limits of Atlanta.
Yeah, I'm so mad at myself. When I was purchasing a home, I wanted to stay in a certain area. I wanted to stay in Douglasville, but I actually wound up buying a home in Atlanta.
Oh, okay.
So because, what was it? Douglasville didn't have any first-time home time.
Georgia Dream.
Yeah, I was just there's nothing for me to use. But then I wound up buying a house in Atlanta and then never thought to go back to look for a first-time home buyer situation.
Really?
Yeah. Dumb as rocks. I was like, man, I wish I could do that all over again. Right. I got it with no problem, but still, I would have liked to take advantage of something.
Absolutely.
Do they have anything for posts?
Right.
No.
Too bad, so sad.
Unfortunately.
2 years in, home buyers.
So, Micole, kind of give us an idea when you talk about the first-time home buyer programs. What type of assistance do people get?
So, for instance, let's talk about the city of Atlanta, since we just, not to rub it in.
Exactly.
But
this is what you miss, Chris. This is what you miss now.
So, they are really, really trying to get people, the first timers, to come, to move back in the city. For affordable housing is a big deal. So they have a program, and it's all income level driven. But you can get up to $45,000 in assistance, depending on your income. Yeah. Yeah.
I just want to go home.
Right. And up to what income level can you get help?
When you're going on that higher level, you can get it up to, depending on how many people are in your household. So, for instance, a one person, you can be I think it goes up to $64,850 or something.
Okay.
Then you'll get $10,000 plus an additional $20,000. So the Atlanta Housing Authority is a partner with Invest Atlanta, and they also would give you $20,000 of their money if you're under, I think it's $64,000 or $65,000, something like that.
Okay. I mean, that's real
It's
money.
huge.
That's a lot of money.
That's
I
a lot of
know
money.
it.
Yeah.
So people, please take the time, do your
Yes.
research, no matter what city, state, county
Yes.
that you live in, because you definitely want to take advantage of whatever program.
Yeah,
you may not live in
absolutely.
Atlanta, but you may live someplace else where they have great
You have to be
incentives.
aware.
Thank you, Micole.
Thank you, Liz.
Yeah,
I
I've learned so
enjoyed it.
much today, and thank you all for tuning in to another episode of the Never Broke Nation podcast, where we help you make, save, and grow your money. And Chris, tell everybody where they can find us and follow us.
Yes, as usual, we are we're at Never Broke Nation on Instagram, Facebook, and YouTube, and you can also find us on iTunes as well.
Thank you, everyone.
Thank you.